The economic fallout of the health crisis has greatly shaken global financial stability. America has fallen into such a steep recession that previous crises now look like good times. Up until this point, over 70 million jobless claims were registered, and at least 10% of the entire U.S. workforce remains unemployed. The amount of debt accumulated by households and businesses all across the country has made banks record roughly $1 trillion in losses, with hundreds of billions more forecasted. Simply put, the United States financial system is on the verge of disaster, and mounting difficulties could spark a bank collapse that's likely to push America even deeper into the financial abyss. That's what we're going to expose today. So, welcome to today's Epic Economist video. Don't forget to give this video a thumbs up, share it with your friends, and subscribe to our channel to keep updated with future videos. After the health crisis exploded in America, both our economic and financial balance was severely disrupted. No individual, business, industry, or segment of our society remained unharmed, but the challenges faced by the banking system were kept out of the spotlights. Banks aren't merely commercial enterprises, but providers of essential services to individuals and entire communities, playing a crucial role in the functioning of the economy. The banking industry is a primary source of financial stability, as banks protect our savings and they protect our investments. They provide sound credit and financial support. Banks perform safe payments and transaction services and offer reliable advice. When the recession started, banks in the United States were still backed by ample capital and liquidity, and have acted quickly to protect their staff and their clients. Most have instituted remote work arrangements and have closed or reduced operations to adapt to the new reality. Millions of individuals and businesses have received forbearance where needed, and banks functioned as crucial transfer channels for the liquidity issued by the Federal Reserve and for the credit and loan forgiveness provided by the Paycheck Protection Program and the Main Street Lending Program. In short, in the early stages of the health crisis, United States banks offered critical support to our society. However, the challenges ahead are complex and the path is uncertain. Unemployment rates largely exceeded Great Depression levels. Hundreds of thousands of businesses have permanently closed, and over 25% of small businesses predict declaring bankruptcy in the next 6 months. Industries such as oil and gas, travel, and retail have been the hardest hit by the recession and are likely to be completely restructured. For its part, banks were affected by record low interest rates and a flattened yield curve, which means net interest income has significantly declined. Credit losses are expected to exceed $1 trillion, and the effects of it will extend over many years, experts say, perhaps more than a decade. Although U.S. institutions have entered the current economic downturn better equipped and with greater capital and liquidity resources than they had at the beginning of the global financial crisis, our economy has suffered unprecedented damage. U.S. banks are burdened with a staggering amount of credit losses. According to experts with the management consulting firm McKinsey & Company, credit losses may range from $400 billion to $1 trillion between 2020 and 2024, and net interest income may decline by up to $200 billion from its 2019 baseline, considerably compromising revenues over the next 18 months and possibly sparking a widespread bank collapse. And while we see those losses extending beyond the next 2 years, reduced demand and tightening of credit availability will most likely be major parts of the revenue impact in 2022 to 2023, experts added. Credit losses are forecasted to disproportionately come from commercial and industrial or C&I loans to the industries most dramatically affected by lockdowns. For instance, in the retail, transportation, and automotive industries, over 50% of issuers have already been re-evaluated by the credit agencies. Oil and gas borrowers will also face hardships, as approximately 40% of producers might face insolvency if prices stay at current levels. Accordingly, C&I loan losses are also going to be significant, with cumulative charge-off rates between 2020 and 2024 ranging roughly from 4 to 10%, depending on the scenario, McKinsey said. Additionally, commercial real estate loan loss rates are bound to reach similar levels, with numerous hotels and retail properties heavily affected and at serious risk of loan default. But unsecured consumer lending will be the hardest hit, considering that during the first 7 weeks of the crisis, more than 33 million Americans have filed initial unemployment claims, which was way more than during the entire global financial crisis, as many struggled to make ends meet. They resorted to credit cards to afford basic utilities and everyday essentials. But credit cards could see cumulative charge-off rates of 25 to 41%. On top of that, mortgages and home equity loans could face charge-offs varying from 1 to 7%, depending on the property price, which is quite uncertain at the present, as interest rates started to soar and government forbearance programs are still in place. Consequently, loan, securities, and derivatives portfolios are likely to face extreme downward pressures, setting the stage for a banking collapse, particularly considering that several other sources of bank income have already started to dry up. In 2020's first quarter, the 6 major Wall Street banks, including Goldman Sachs and Bank of America, have announced acute profit declines caused by large provisions for loan losses. Executives at these banks revealed an enormous uncertainty surrounding the depth and timeline of the economic recession. Michael Corbat, CEO of Citigroup, stated, "No one knows what the severity or longevity of the virus's impact on the global economy will be." They were highly unsure about how much the ongoing crisis could actually damage banks' balance sheets. Even J.P. Morgan Chase & Co. CEO Jamie Dimon has openly stated, if the economy gets worse, we'll bear additional loss. After the previous financial crisis of 2007 to 2008, policymakers tried to improve a series of safeguard measures to reduce the chances of instability in the banking system, which have contributed to the initial resilience seen on the system at the beginning of the current recession. Some banking sectors, such as shadow banking, however, needed immediate government intervention. The Federal Reserve then implemented extraordinary emergency measures, including stimulus plans, tax rebates, and record low interest rates, in an effort to prevent total collapse, since the entire economy was at stake. But as we have repeatedly discussed in this channel, very quickly things spiraled out of control, and the primary response to the issues brought on by the health crisis was the issuance of more and more liquidity. That's why McKinsey experts stress that Federal Reserve's bank capital decision-making over the past several years, in conjunction with the Federal Deposit Insurance Corps and the Office of Comptroller of the Currency, OCC, has needlessly increased the vulnerability of the banking system. This is especially concerning, as the economic fallout from the sanitary crisis can still escalate in the coming weeks and months, which means that much more financial pain is yet to come. And at this point, there would be no alternative to reverse the widespread bank downfall triggered by the current policies. Policymakers and regulators should have required banks to keep building their loss-absorbing capital buffers while profits were high and the economy was booming, the experts say, but instead, they moved in the opposite direction, deteriorating the resiliency of banks large and small. They continued to undermine bank capital requirements throughout the current recession. The emergency measures taken allowed banks to pay out more capital to shareholders and to carry on with alarmingly low levels of capital. In other words, just as we've seen before, the lethal combination of the credit losses, the collapsing housing market, soaring energy prices, and the threat of rising inflation are all contributing to the rapid decay of America's economy. If policies aren't reversed, or at least kept under control, and borrowers become massively delinquent on their loans, the potential bank collapse will affect several other financial institutions such as pension funds, mutual funds, and insurance companies. There are many things we learned from the 2008 global financial crisis that we should all keep in mind right now. Banks are institutions traditionally operated by taking deposits from their customers and lending money to those seeking loans. The difference between the interest rate paid on deposits and the spread, which is the higher rate charged on loans, is how they make a profit. So, when clients default on their loans, banks are liable depositors for payment, which means they are 100% responsible. Therefore, it's in a bank's interest to carefully assess customers' ability to repay before providing loans. To do so, they usually analyze credit scores, look at employment status, adequate assets, and the ability to make a sizable down payment. However, that cautious dynamic changed after banks started to seek higher profits to satisfy shareholders and executives, a trend that's occurring since the 1990s but has considerably intensified during the current market rally. Banks started to loan out more money so they could collect more profit in a process known as securitization, which allows banks to convert hundreds, even thousands of mortgages into bonds and then sell the bonds to investors, such as pension funds, mutual funds, insurance companies, and other banks. In that way, banks didn't profit through the spread anymore, but instead they made a fee for having originated the loan that now were owned by other investors. The bonds are then insured by specialized insurance companies and were rated as safe or risky by the rating agencies, such as Standard & Poor's, Moody's, and Fitch. Now, some experts argue that the banking collapse will be fueled by banks' greed to make more profits no matter what. Before the health crisis ever started, bankers were repeating the same mistakes they did during the previous financial crisis. As explained by David C. Pack, since the loans were now off the books and insured, the banks felt comfortable about originating even more loans. Through their new fee-based income, banks made much higher profits than ever before. In their quest for higher profits, banks no longer felt the need to carefully screen loan applicants as they once did. Customers who did not qualify for loans under the bank's standard lending procedures, known as subprime customers, were now targeted as a lucrative source of income and marketed aggressively too. Loans were provided to people with no income, no job, and no assets. Now, we are seeing the exact same scenario, but the unexpected arrival of a ravaging health crisis has added a twist that bankers and bondholders couldn't see coming. Suddenly, a large chunk of the population and countless businesses have lost their ability to meet their loan payments and so far have accumulated over $40 billion in rental and mortgage debt. The same that happened before is happening once again right now. The subprime mortgage market is becoming a ticking bomb, ready to explode at any time. As the economic recession is still being aggravated by several determinants, mortgage default rates will likely keep soaring as more and more businesses go bankrupt. Investors were left holding bonds that may never be repaid, which means it's becoming increasingly difficult for banks to sell more bonds as mortgage rates are surging, and investors have already started to run for the exits. Thus, a bank collapse is expected as their fee income is close to drying up, and when that finally occurs, there would be enormous deficiencies in capital. The credit crunch would then affect businesses and individuals' ability to financially recover. Now, this is going to impact entire cities, as major urban centers are witnessing a commercial real estate collapse, and municipal bonds are used to fund cities' maintenance, colleges, hospitals, and whatever. Every aspect of the economy will be on the hook, and the higher interest rates go, the lower will be the borrower's ability to meet their late payments, which will result in even more defaults and will worsen the current recession. To put it another way, a bank collapse is only a matter of time, and it will create a financial tsunami that will jeopardize America's recovery and growth for years and years.